When the market gets to this point, we have to ask ourselves, how far overbought is the market relative to what it has done in the past? Look at the Nasdaq Composite, how far above its 200-day moving average. Has it ever been this far above its 200-day moving average? And the 200-day moving average is the blue line. So if you take a look at the blue line right here, you have the 200-day moving average, and there has never been a time in the history of the Nasdaq where it has been this far point-wise above its moving average. So you're talking about 2,200 points roughly above its moving average, 2,200 points. But to be fair, we have to look at this value divided by its close to determine its percentage above its 200-day moving average to compare it to the past, because historically these values were the index values are smaller, so the point values will be smaller. So percentage-wise, it has been above these levels, and I want to show you that. We're going to talk about the 1987 crash, the 1998 crash, and how that led to the dot-com bubble. And it looks a lot like this. The 1998 crash looks a lot like this. When the Nasdaq got here and ran this red line, it went up by 2.5 times in value. So if the Nasdaq Composite did that, we're talking over 25K on the Nasdaq. I'm not a perma bull or typically a bull in general, but I'm just looking at the data. And we're going to talk about the 2001 or 2000 dot-com bubble and the crash there. These are kind of connected. We're going to talk about the 2008 crash, the financial crisis. And so I'm going to show you the indicator for this. At the bottom, I have the indicator. And the indicator, what this represents, the yellow line is the zero line. The red line is the current close above the 200-day moving average, the difference between the close and the 200-day moving average divided by the close. So it's up about 19.38% above its 200-day moving average. And then the low in March, it was down about 22.27%. And just to give you some perspective, the dot-com bubble minus 91% below its 200-day moving average, and it's been much higher. It was much higher than this on its above the 200-day moving average on a percentage basis. But when it got to this point above the 200-day moving average, it went up by 2.5, a factor of 2.5. So let's look at the history. I want to show you the indicator first, so you can put this in your trade station if you have it. You have your inputs, you have your variables. You have this. This is the what it's measuring. The difference is equal to the price, which is the close, minus the fast calculation of the average of the close of 200 days. And then we plot the difference divided by the close. We plot 2, 3, and 4, just the fixed current values, the high, the current value today, the low value in March, and the zero value. And we're going to see how that compares historically. So let's do that. Let's first scroll back so you can see where the white line falls in relation to the red and the blue line. And so let's scroll back. You see 2016 was a dip, but not anywhere near what we had here. The end of 2018 was a big sell-off, but not what we had in March of this year in the pandemic. Let's go back. Let's continue to scroll back to the 2008 financial crisis. So you see the 2008 financial crisis, the market is down here at levels of about 68%. 68%. And when it rebounded, look where it rebounded to, this red line. But it came to this red line, and it didn't immediately sell off. Here's the red line. It didn't sell off. The moving average caught up as the trend slowed down, as it still moved higher. And then it did trade below the moving average up here. And so, but much steeper crash, but the rally back to 20% above the moving average. You see that occurred in July of 2009, so about 8 or 9 months later. So now let's continue to scroll back to the dot-com bubble era right in here. And we're going to include 1998 in this because 1998 looks kind of like this. This 1998 hedge fund currency crisis. I forgot what happened. But it's similar. It came back to this blue line where we are in the pandemic, 22% below its moving average, and then a straight line up, kind of like we have now. So it's above it. It was in a bull market above it, and then it sold off 22% below its moving average, and then this really straight line rally back. Straight line rally back to where? This red line, right here where this red line is. And so then it got choppy in here. But it stayed above its 200-day moving average, and then when it got to this point in October of 1999, it soared. But the price of the Nasdaq was around, let's see, 2000. It was around 2000 when it crossed that red line, somewhere here between 2000 and 2500. So you could just say 2 to 2.5 times higher at its peak is when it went parabolic. So if the Nasdaq currently did that, it would go to over 25,000, 20 to 25,000 range, just rounding it up from 10,000. It's currently at 11,500. So, but then it kind of wiggled in here. It got closer to its moving average, and then it soared even higher to these levels. And so these levels right here were 35%. 35% above its 200-day moving average, close to 40% at its peak. So we could just because you're at this red line doesn't mean you can't go much higher. It can. So the point is to be careful trying to short this market or call a top, because you can get blow off tops like this. Let's look at it again. Back in the 1987 crash, you see a crash right here in 1990 as well. It goes below the blue line, the pandemic sell-off blue line, to levels that are 28% roughly, and then back to the red line. You know, that red line tends to be a point where it can kind of cool off, not necessarily pull back. The moving average can catch up when it's 20% above its moving average. And then we go to the 1987 crash. It crashes way down here, 44% below its moving, 44% below its moving average. Really sharp move. You see it came up to this red line back here, came close to the blue line. It's illiquid, more illiquid back here. This is way before my trading days. I was still in junior high back here. And then come up here to this red line. Look how straight this line is. You hear about traders who would compound $10,000 accounts to $250,000 accounts quickly. Not possible in today's margins and volatility, but in years of past, you could get very straight line trends with very low margins and compound quickly if you can get trends that are this straight line. There's much more noise in the market now, so much harder to do, pretty much difficult to quickly compound 10K to 250K in a few months. But this is the kind of price action that was favorable to that. And you see a pullback here and then a crash here well below those levels. And then did it come back? When did it come back to the red line? So it finally came back to the red line in 1991, 20% above, after going below the blue line again. So that's a little bit of the history of the Nasdaq Composite and how it's responded, how the market has moved around its 200-day moving average over the years, to give you some perspective for the current market environment. We are just now getting to this red line, similar to that 1987 move where the market traded down about 20% plus and then went straight up, and then volatility picked up and then it doubled, went at 2 to 2.5 times higher over the next 1.5 years. So be careful. I love the opportunity that our systems have to trade this type of market, whether it becomes more volatile here or we get a blow off top.